IRS Form 8697, Interest Computation under the Look-Back Method for Completed Long-Term Contracts. The vast majority of taxpayers will probably never see this tax form or much less file it. And those who do file it will probably be using the services of their paid tax return preparer in order to do so. To calculate interest, you can use one of two methods, which are covered in parts 1 and 2. Part 1 covers the regular method, and then in part 2, there is the simplified marginal impact method. Now, taxpayers generally will use part 1 or part 2. They do not use both. In part 2, you would use the simplified marginal impact method to simplify your calculations. So basically, your prior year hypothetical underpayments or overpayments are calculated using an assumed marginal tax rate. This tax rate is generally the highest statutory rate in effect for the prior year, either for individuals or corporations. So this method eliminates the need to recalculate your tax liability based on actual contract price or costs each time the look-back method is applied. You simply assume the tax rates at the marginal tax rate, and then it simplifies your calculations. But you must elect this impact method, the simplified marginal impact method, by attaching a statement to your income tax return for the first year of your election. You indicate on the statement that you are making an election under Treasury Regulations Section 1.460-6D to use the simplified marginal impact method. Now, once you elect this method, this election applies to all applications in the year of election and in future tax years, unless the IRS consents to a revocation. So in other words, once you start using Part 2, you're going to be using Part 2 in the future unless you request permission to go back to the regular method. Now, there are a lot of nuances in here that we won't cover in the video, but we do cover them in our article. So there are certain exceptions for construction contracts, small contracts, and a de minimis exception. And there are other considerations that you would take into account when doing this. So we're going to use our fictional character, John Doe, and we're going to walk through each, the regular method and then the simplified marginal impact method. The numbers are not necessarily accurate. They're really there for kind of illustrative purposes. So you're going to find a lot of the information you'll need to perform these calculations are not on the tax form. You're going to have your prior tax information and all of your adjustments to income handy in order to complete this form. So let's start at the top where we go over the instructions that all taxpayers must complete. So at the top of the form, you can see that we entered the beginning and the ending date of the tax year. So for John Doe, he's an individual. His tax year was the calendar year for 2022. And then we're going to enter his name, address, and then his social security number up here in line A. If John Doe were filing as an S corporation or a state or a trust or some other entity other than that as an individual, then you would enter the employer identification number in line A. In Part B, you check the applicable box to indicate the type of taxpayer that's completing this form. And then in C, we're going to assume that John Doe is reporting this as an owner of an interest in a pass-through entity. In this case, his pass-through entity is John Doe Enterprises. We've entered his employer identification number. And then if we had more than one entity, we would have to attach a separate schedule outlining all the different tax entities and listing the different contracts. So in part one, we use the filing year, which is the current tax year or the tax year that you're reporting for here, and then redetermination years. So there are two columns. You can apply 2 different years. If you need to apply more years, you can add additional copies of the Form 8697. But this column C, which represents the totals of columns A and B, you'll only put this on the primary version of the form. So if you have 4 redetermination years, you would use 2 forms. You would only enter any column C information on the form that you plan to file, either with your tax return or by itself. So if you end up owing money, specifically interest to the IRS, then you will file this with your tax return, and then you will pay the additional tax when you file your tax return. If this results in a net refund to you, then we'll go over the filing instructions, because you will not be filing this with your tax return. You'll be filing it separately and then expecting the IRS to issue a refund once they've determined that your calculation is correct. So in line 1, we're going to enter the taxable income or the loss for the prior year shown on the tax return. Now this income or loss is before net operating loss, capital loss carrybacks. If you were required to file this form in a prior year, you would simply enter the adjusted taxable income from this line 3 amount. So for future instances, you would use these line 3 amounts up here in the taxable income column row. So we're just going to state in this instance that each income year was $100,000 per year, and then we're making an adjustment in line 2 to reflect the difference between the estimated contract price and the actual contract price and costs. So in this case, we ended up basically just kind of inputting a number that showed the contract costs increased in $20,000, but it was actually decrease in the prior tax years. So it's a net result of 0 because a lot of this work got pushed into 2022 that was expected to be done in 2021 and 2020. So in line 3, we combine those lines, and we end up with 120,000, 90,000, and 90,000. In line 4, this is where you would calculate the income tax liability. This is where you would have to do a lot of heavy lifting by going back into the prior tax years to determine the applicable taxes for each year. In this case, I took a shortcut. I just applied 10% across the board. Again, this is for illustrative purposes. This would not actually reflect John Doe's real situation. So in this case, this should be actually $12,000. So $12,000 in 2022, but instead of $10,000 in 2021 or 2020, it's actually $9,000. So this 10%, we put in the $10,000 that we had paid in prior tax years, and then in line 6, this represents the net increase or decrease for the prior years. So we subtracted line 5 from line 4, we get a net decrease in the tax bill for each year. So $1,000 in 2021, $1,000 in 2022. Now, you may end up completing line 7 and line 8, but for each individual column, you're going to only complete 1. So because both of these were decreases in tax responsibility, they ended up becoming refunds. I used a 5% interest rate. but you're actually going to have to go back into the IRS website. And again, we have links to it in our article so that you can apply the appropriate interest rate based on the prevailing tables. So in this case, I just put in $50. The IRS had been holding $50 or $1,000 from each of those tax returns. We put in $50, 5% interest for each one. That results in $100 of interest. Now let's imagine that this was actually, we owed $1,000, and so now this $50 goes up here. So instead of having $100 come back to us, we actually have 50 and 50, and then we would have to net those out and determine the refund, which in this case would be 0. All right, so so we're taking this $100, and because this is the refund and there is no net increase in tax, line 8, column C does exceed line 7, column C. We enter the excess in line 9. Now, you have to file IRS Form 8697 separately from your tax return. You would actually mail this completed form. There are 2 different IRS offices, one for individuals and then one for all other taxpayer entities. So we have the mailing address for both of those in our article. You can also find all of this in the form instructions. So that would do it for part 1. Now again, if you end up in a situation, so if you end up mailing this off, you do have to complete the taxpayer information form because you're signing it and you're submitting it by itself. So this is the sworn statement under penalty of perjury that you're filing everything accurately. If instead of this you ended up having to owe $100, then you would not need to sign this taxpayer form because you're filing this with your income tax return, whether it's a Form 1040, 1041 for estates and trusts, whatever the case may be. Your sworn signature is already part of your tax return, so you don't need to sign it again. So now we're going to move on to part 2, so this is where we kind of simplify some of the taxes by incorporating basically the highest marginal tax and alternative minimum tax instead of having to go back and recalculate every single tax liability for every single prior year. So there are 3 columns for interest computation purposes, and then when we get down to row 8, this is when we'll start to open up column D so that we can net these total numbers together and figure out net amount of interest that you owe or net amount of interest that is owed to you. And remember, if you are completing this form, whether it's part 1 or part 2, you should only see one number in either line 10 or line 11, but not both. In part 1, it would be line 9 and line 10, again, but not both, because you're either owed interest or you owe interest, but both cannot happen once you net all of those totals. So in line 1, we enter the adjustment to taxable income, not the income itself. So in columns A and B, we put these prior tax years. We did not put the current tax year. So we just entered the adjustment, which was $10,000 per year. And then we entered the increase or the decrease in tax for each of those years. So we used the tax liability, basically the 10%. If you went to the form instructions, they actually give you tax rates based on each year. So for 2021, if you're an individual, which John Doe is, we would be filing at the 37% tax rate and calculating there. So again, the simplified marginal impact method assumes that you're at the highest tax rate. So this The table goes all the way back to before 1987, where they used to have a 50% highest marginal tax rate. A word of caution, you may decide before electing the simplified marginal impact method to maybe calculate your interest and tax liability under both for prior years, and based on your situation, make your election on whether or not you're going to simplify or do the regular method. For large dollar amounts, you may find that there is a significant difference in doing it one way or the other. And in a lot of situations, the regular method may be more tax efficient for you, even if it takes a little bit more work. So having calculated our net increase or decrease, again, we're not using the 37% number. We're simply using our made up 10% number. We're going to make an adjustment to alternative minimum tax to reflect the difference. So in this case, we just made this the same number, negative 10,000. So what we're doing is we're making the adjustment to regular taxable income, and then we're making an adjustment for AMT purposes, the difference between the actual and the estimated contract. And then you would enter the increase or decrease in AMT, and again, the AMT tax rates are in the form instructions. They're also in our article, so you can see in which case, like what the difference would be. So it turns out that in this case, the $10,000 decrease, would be bigger under the AMT. Now, if I actually use the 37% tax rate, then we would find out that this is actually the bigger number when we come to the larger of either line 2 or 4. Oops, made that mistake on the wrong line. So we would enter 3,700. Now, if you're a pass-through entity, you can skip line 6 where we calculate the overpayment ceiling, and you would just bring this number right down to here. So the overpayment ceiling, for each column where there's a negative number, you'll enter your total tax liability for the prior year after adjusting for previous applications of the look-back method, after net operating losses, after capital losses, net section 1256 contracts losses, credit carryovers, and carrybacks. So for each column where line 5 is a positive number, you simply leave line 6 blank, and then you enter the line 5 number down on line 7. So I simply put in negative $2,000, but you would have to actually put in all of those calculations to determine which one is the appropriate number. And then your net increase or decrease in the tax bill based on that is the smaller of either line 5 or line 6. So you'll treat both numbers as positive when you make the comparison, but then you enter the amount. So we're actually going to enter the minus 2,000. And then, because these are both decreases, we would not enter anything into line 8. But we're going to change this, and we're going to pretend that this number is actually a plus 2,800. The interest to be refunded on decrease, again, you have prevailing interest rates, which you can find on the IRS website because they do get updated quarterly. So what we would do here is we're just applying the 5% rule here. So $100 decrease in column A, but then because this is an increase in your tax bill, we've got $140 in column B, that's on line 8. And then we net all of that over on one side. So 140 and then 100. So when we net these together, we get a difference of $40 of interest that we owe. Because we owe this, we would file this with our tax return and not necessarily separately. If you were owed interest, then you would file it separately. So there are different applications. So if you do owe tax on look-back interest, there is not an estimated tax penalty for that. There are several nuances that we can't cover in this video. Most of those nuances are covered in our article, which you can find on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8697 in the search bar, and you should see our article. If you like our articles, please subscribe to our newsletter, and if you like our YouTube videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments, please post them in the show notes or in the comments section. Thank you very much and have a great day.